How wealth compounding works in business. The ideal business is one that earns very high returns on capital and that keeps using lots of capital at those high returns. That becomes a compounding machine. There are 3 C's: clean balance sheets, strong competitive advantages versus peers, and superior capital allocation skills. A core tenet of this potent combination is the ability of these businesses to generate free cash flows, FCF, and grow them at a healthy rate sustainably over the long term. Now question come, what is FCF? FCF is the cash left over for distribution to shareholders after providing for all the firm's commitments with respect to core operations, raw materials, payroll expenses, etc. Capital expenditures, new plants, machineries, etc., and increase in working capital, money set aside to meet short-term obligations like payments to vendors, etc. Two firms A and B have exactly same income statement metrics, like revenues, say 1000 rupees, operating profit or EBITDA, 500 rupees, and same net profits or PAT, 100 rupees. However, their capital efficiency, measured as return on capital employed or ROCE, is different. Firm A has an ROCE of 10% while Firm B has an ROCE of 40%. This means that to generate 100 rupees of net profit, Firm A deployed 110% or 1000 rupees of equity capital. Firm B, on the other hand, deployed 140% or 250 rupees only to generate the same profit. Why is ROCE important? It is important because to achieve growth in profits next year and in the future, additional capital will need to be deployed back into the business. The amount of capital needed in turn would be dependent on the firm's ROCE. Let's continue the example above to see how this plays out. To achieve a growth of 10% in net profits, i.e. from 100 rupees to 110 rupees, Firm A would need to deploy additional capital of 100 rupees, calculated as increase in profit of 10 rupees divided by ROCE of 10%. To achieve the same growth of 10%, Firm B, on the other hand, would need to deploy additional capital of only 25 rupees, calculated as increase in profit of 10 rupees divided by ROCE of 40%. This additional capital which is needed to fuel future growth comes out from the profit base of last year. So, Firm A would need to put in entire profit of 100 rupees that it had earned back into the business to generate profit growth of 10%. Firm B, on the other hand, needs to invest only 25 rupees and hence is left with 75 rupees for the equity holders. This cash which is left over is the free cash flow. This free cash flow available can be used in 3 ways. 1. Return capital back to shareholders through dividends, share buybacks. 2. Invest higher amount into the business to generate even faster growth. For example, Firm B can redeploy entire profit of 100 rupees and generate 40 rupees of additional profits, or 40% growth, vis-a-vis only 10% for Firm A. Three. Build its cash buffers to be able to capitalize on opportunities during times of distress. For instance, Firm B in the above example can just set aside 75 rupees for later use when an opportunity to acquire high-quality asset at distressed prices presents itself. Sustained growth in free cash flows is driven by healthy rate of capital reinvestment with high ROCE. All of this being said, the ability to generate high free cash flows in future is not the biggest driver of value for a shareholder. An even bigger driver of value is the firm's ability to sustain a high rate of growth in free cash flows in the future. The longer a company stays in the zone of high FCF growth, the higher the intrinsic value generated by that company, as such companies have much longer as well as higher FCF generation. Thanks for watching.